Guys, gold and silver just topped out, and this is what comes next. We're watching something that almost nobody is paying attention to, while everyone's been obsessed with the precious metals mania. There's one industrial metal showing incredible relative strength, and the stock that I'm going to share with you in the second half of this video could be one of the best positioned plays for what's coming in the commodities market. By the end of this video, you'll understand exactly why copper is the smart move right now and how to take advantage of this opportunity before the crowd figures it out. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, if you're the one making the actual purchases and sells, you have to do your own due diligence as well. Take your time. Be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now let's get into it. Here's what just happened and why it matters. Gold and silver are showing classic topping patterns. We're seeing what technical analysts call topping tails. These are reversal candles that form after parabolic moves. They signal that the speculative phase is over. Gold spiked to new highs and then collapsed intraday. That kind of volatility doesn't happen in a healthy bull market. That's what happens when leverage gets flushed out of the system. Silver did the same thing. Huge surge followed by a massive reversal. The charts are putting in long upper wicks with closes in the lower portion of the range. That's textbook distribution. That's smart money selling to dumb money. And what makes this even more significant is the context. These metals went parabolic, 9 straight months of gains in silver. That's never happened before in the entire history of the market. When something goes that vertical, the correction is always violent, always. And we're starting to see the early signs of that correction right now. People got way too leveraged. Margin calls came in, forced liquidation started. And once that process begins, it feeds on itself. Sellers beget more sellers. Stops get hit, more selling, it cascades. Now, I want to be very clear about something. I'm not saying the long-term bull market in precious metals is over. The reasons people bought gold and silver are still valid. The dollar is still weak. Debt is still massive. Central banks are still buying. But the parabolic phase is done. The easy money has been made. And what usually follows a parabolic move is a serious correction. We're talking about a potential pullback of 20 to 45% from the highs, maybe more. That's what happens when speculative manias end. The late buyers who chase the move up get crushed, and that pain creates the conditions for that next leg higher eventually, but that's months away, maybe longer. So if the precious metals trade is rolling over, where does the money go? Because capital doesn't just disappear, it rotates. And right now, it's rotating into the one metal that everyone forgot about while they were chasing gold and silver. Copper. Copper showing incredible relative strength. While gold and silver are putting in topping patterns, copper is hitting new all-time highs. It's breaking out, it's leading, and that tells you something very important. It's what the market's pricing in. The market's shifting from pricing in collapse to pricing in growth. Let me explain why this matters. Gold and silver benefit from fear. When people are scared about the dollar, about debt, about the system breaking, They buy precious metals. That's a defensive trade. That's insurance. But copper benefits from economic activity, from building things, from growth. Copper is what I call the PhD metal. It has a PhD in economics. You need copper to do everything. Anything with electricity requires copper. Data centers, electric vehicles, power grids, wind turbines, solar panels, industrial manufacturing, all of it runs on copper. Is copper down slightly? Sure, but the market is holding up copper, and that shows that the market cares about economic activity. While everyone was panicking about dollar collapse and buying gold and silver, the real story was happening in copper. Because the AI boom isn't just about software, it's massively physical, and it requires enormous amounts of copper. Let me walk you through the numbers because they're staggering. The world is projected to face a copper deficit of 10 million tons by 2040. That's 33% of current global demand. Think about that. We're consuming way more copper than we're producing, and demand is set to surge to 42 million tons annually. Asia alone will account for 60% of that demand growth, driven by electric vehicles and grid upgrades. Now, you might be thinking, well, can't we just mine more copper? No, we can't, at least not quickly, and this is where the supply story gets really interesting. The supply of copper is flat to declining. All the high-grade mines have been mined already. The easy copper is gone. What's left requires moving mountains of rock to extract small amounts of metal. Robert Friedland, the billionaire mining mogul, put it perfectly. He said we're consuming 30 million tons of copper per year. Only 4 million tons of that gets recycled. So just to maintain 3% GDP growth with no new electrification, we have to mine the same amount of copper in the next 18 years that we mined in the last 10,000 years. Read that again. The same amount in 18 years as the last 10,000 years, just to maintain current growth rates. Not counting AI data centers, not counting electric vehicles, not counting grid upgrades, not counting the green energy transition. All of that is additional demand on top of baseline consumption. Stanley Druckenmiller, one of the greatest investors of all time, said he's never seen a better setup in his life. He's talking about copper. The supply and demand situation is so tight that he thinks it's going to explode. And when Stanley Druckenmiller says he's never seen a better setup, you pay attention. This guy ran George Soros' fund. He's seen every market cycle for 50 years, and he's saying copper is the trade. Now, let's talk about why the supply can't catch up with demand, because this is critical to understanding why copper prices are going much higher. It takes 15 to 20 years to bring a new copper mine online. From discovery to production, the average timeline is about 16 years. You have to find the deposit, drill it, prove reserves, get permits, build roads, build infrastructure, bring in power. It's a massive undertaking. So even if we started 10 new copper projects right now, they wouldn't produce meaningful amounts of metal until the late 2030s or early 2040s. But here's the problem. We're not starting 10 new projects. We've been underinvesting in mining for over a decade. Why? Because after the last commodity supercycle crashed in 2015, nobody wanted to touch mining. Prices were low, returns were terrible, capital fled the sector, and now we're paying the price for that underinvestment. Demand is going vertical, supply is stuck, and there's no quick fix. You can't just flip a switch and produce more copper. The cupboard is bare, and that's why we're seeing things like Amazon getting into the mining business. Amazon Web Services signed a direct supply deal with Rio Tinto to reopen the Johnson Camp mine in Arizona. This mine has been dead for over a decade. No production, shut down, and Amazon is bringing it back to life because they need copper for their data centers. They're even using experimental techniques like bioleaching, where they use bacteria and acid to extract copper from low-grade rock. Think about that for a second. Amazon is one of the most valuable companies on earth. If copper were available on the open market, they would just buy it. Instead, they're reopening dead mines and using bacteria to extract metal from waste rock. That tells you everything you need to know about how tight the supply situation is. Now let's talk about the demand side, because it's not just AI. Although AI is a huge driver, every data center requires massive amounts of copper for power transmission, for cooling systems, for backup generators, for all the wiring that connects the servers. An AI query uses 10 to 100 times more power than a regular Google search. And all of that power requires copper. But AI is just one piece of the demand puzzle. Electric vehicles use 3 to 4 times more copper than a regular gas car. A single EV requires about 80 pounds of copper, and EV adoption is accelerating globally. China is leading, Europe is pushing hard, the US is ramping up. All of those vehicles need copper. Then you have the grid upgrade cycle. The US alone is spending over $400 billion upgrading the power grid. The existing infrastructure is ancient. It can't handle the load from EVs and data centers and renewable energy. So we're rebuilding it. And that grid upgrade could require 15 million tons of copper just in the US by 2030. Then you have renewable energy, wind turbines, solar panels, all very copper intensive. A single wind turbine uses about 4.7 tons of copper, much more than a coal or natural gas plant per unit of power. So as the world transitions to greener energy, copper demand goes up, not down. And here's the kicker: defense spending. Countries are rearming. Defense budgets are going up. The US wants to increase defense spending significantly. Every missile, every jet, every ship, every drone is loaded with copper. And as militaries electrify and build more autonomous systems, copper demand from defense goes even higher. So you have AI, EVs, grid upgrades, renewable energy, and defense all driving demand at the same time. All structural trends that aren't going away, and all requiring the same metal, copper. Now let's talk about price dynamics, because this is where mining stocks get really interesting. Copper is currently trading near all-time highs. It's broken out of a multi-year range. It's showing strength while other metals are rolling over. And the demand drivers I just outlined suggest prices are going much higher over the next few years. But here's what most people don't understand about mining stocks. They don't move one-to-one with the metal. They move with much more leverage. Let me explain how this works. Mining companies have relatively fixed costs. It costs roughly $3 per pound, all in sustaining costs for major copper producers to get the metal out of the ground. If copper is trading at $6 per pound, the mining company makes $3 in profit per pound. Now, let's say copper goes from $6 to $9. That's a 50% increase. But the mining costs stay at $3. So now the company is making $6 per pound in profit instead of $3. Their profit doubled even though copper only went up 50%. That's leverage, and it's why mining stocks can move 100% or more when the underlying metal moves 30 to 50%. We saw this with gold. Gold went up about 65%, but gold mining stocks went up over 150%. The leverage works. And right now, copper mining stocks are still relatively cheap. They haven't participated in the broader market rally. They've been boring, ignored, forgotten. While everyone was chasing tech stocks and precious metals, the copper miners were consolidating, building a base, and now they're starting to break out. Let me also address the dollar angle, because this is important. A lot of people think higher copper prices automatically mean higher inflation, which means the Fed has to raise rates, which is bad for the economy. But that's not quite right. Yes, higher copper prices contribute to inflation, but they also signal real economic activity, real building, real growth. Right now, the dollar is weak. It's been declining. And a weaker dollar is generally a tailwind for commodities priced in dollars. It takes more dollars to buy the same amount of copper. So dollar weakness supports higher copper prices. And unlike the Fed tightening cycle we saw in 2022 and 23, we're now in a period where the Fed is likely to be more accommodative going forward. There's also a geopolitical component to this. China controls a lot of the global refining capacity for many critical minerals, not just rare earths, but also copper refining. And as the US tries to bring supply chains back onshore, that creates additional demand for domestic production. Mines in North America become more valuable. Companies with assets in stable jurisdictions benefit. Now let's talk about inflation more broadly, because copper is telling us something important. We're seeing inflation in commodities, real inflation. Oil is up significantly. Copper is at all-time highs. Even agricultural commodities like wheat and cattle are starting to move higher. This isn't just one metal. This is broad-based commodity inflation. And what does that mean? It means the reflation trade is on. The market is betting on economic growth, on spending, on building. That's very different from the deflation scare or the dollar collapse narrative that was driving gold and silver higher. The market narrative is shifting from fear to growth, and copper is the best way to play that shift. Let me also talk about the futures market, because there's an interesting dynamic happening. Most metals trade on future exchanges, hedge funds, big institutions. They don't buy physical metal and store it. They buy futures contracts, paper claims on metal. Historically, the exchanges hold less physical metal than the paper contracts represent, because most buyers don't take delivery. But recently, we've seen stress in the physical markets, people actually wanting delivery. The paper to physical ratio has surged in some metals. That creates backwardation where the spot price is higher than the futures price. That's unusual. It signals physical shortage. And while we're not seeing that in copper yet, the dynamics are building in that direction. Amazon buying a mine is a symptom of this. Companies are securing physical supply because they don't trust that the paper market will deliver when they need it. And if that trend continues, copper could see the same kind of squeeze we saw in other metals, except copper has real industrial demand. It's not just speculation. It gets consumed, used up. So a squeeze in copper would have real economic consequences. Now I want to address some risks, because I don't want you to think this is a sure thing. Risk number one: what if the global economy slows down? What if we go into recession? In that scenario, copper demand would fall and prices would probably correct. But even in that case, the long-term supply deficit doesn't go away. It just gets delayed, and any pullback would likely be a buying opportunity for the next cycle. Risk number two: what if China floods the market with cheap copper from strategic reserves? They've done this before with other commodities. It's possible. But right now, China is a net buyer of copper, not a seller. They're building their own infrastructure, their own AI systems, their own EVs. So I don't see them dumping supply anytime soon. Risk number three: what if technology changes? What if we find a substitute for copper? People have been trying to replace copper for decades. Aluminum can work in some applications, but it's not as efficient. It's not as safe. It has more resistance. For most uses, there's no good alternative to copper. So I'm not worried about technological disruption here. All right, now let me get to the specific stock. The company I think is best positioned to benefit from the copper bull market is Freeport-McMoRan, ticker symbol FCX. This is the largest publicly traded copper producer in the world. They operate massive mines in North and South America, and they're exactly the type of company you want to own when copper prices are going higher. Here's why FCX specifically. First, size and diversification. Freeport operates the Morenci mine in Arizona, one of the largest copper mines in North America. They also have major operations in South America, including the massive Grasberg mine in Indonesia. This is a world-class asset with huge reserves. They're not a small speculative miner. They're an established producer with real cash flow. Second, operating leverage. FCX has some of the lowest all-in sustaining costs in the industry. That means when copper prices go up, their profit margins expand dramatically. They have the operational leverage I talked about earlier. A 50% move in copper could double or triple their earnings, and that flows through to the stock price. Third, they're already producing. This isn't a development story where you're waiting years for production to start. FCX is a mining company right now. They're selling copper, generating cash flow, paying dividends. They have the infrastructure in place, the permits, the workforce, everything. So when copper prices move, FCX benefits immediately. Fourth, they have growth projects in the pipeline. They're not just sitting on existing assets. They're expanding, adding production capacity, improving efficiency. That gives them a growth trajectory on top of the commodity price leverage. So you're getting both operational improvements and higher copper prices working in your favor. Fifth, valuation. After years of being ignored, FCX is actually pretty cheap relative to its historical multiples. The stock hasn't participated in the broader market rally. It's been dead money, but that's exactly when you want to buy, before the move happens, before everyone figures out the story. You want to buy when it's boring and unloved. Now let me compare FCX to some alternatives. Southern Copper is another big player, ticker SCCO. They're also a great company, very well run, but FCX is larger, more diversified, better positioned in North America. For most investors, FCX is the better choice. It's more liquid, more stable, and it has similar upside potential. There's also Taseko Mines, ticker TGB. This is a smaller Canadian company with the Florence Copper Project in Arizona. That's a higher risk, higher reward play. It's more speculative, more volatile. For aggressive traders, TGB could work. But for most people building a core position, FCX is safer. And then there's the copper ETF, ticker COPX. That gives you broad exposure to the sector. About 58 different copper companies. That's fine if you want diversification, but I prefer concentrated bets on the best companies, and FCX is the best. Now let's talk about the timeline because this matters. I don't think this is a short-term trade. I think copper is in a multi-year bull market. We could see copper go significantly higher over the next 2 to 3 years as the supply deficit becomes undeniable and demand keeps accelerating. And if copper does what I think it's going to do, FCX could easily double or triple from current levels. That's not a guarantee. Markets don't move in straight lines. There will be volatility. There will be pullbacks. But the fundamental setup is there. Supply is constrained. Demand is growing. And the companies that produce copper are going to make massive profits as prices rise. Let me also mention dividends because this is important for income-focused investors. FCX pays a dividend. It's not huge, but it's real. And as copper prices go higher and cash flow improves, that dividend will likely increase. So you're getting paid to wait while the copper story plays out. That's better than sitting in bonds or cash getting destroyed by inflation. Now let me talk about what makes FCX different from the precious metal miners. Gold and silver miners benefit from fear, from crisis, from dollar collapse. But copper miners benefit from actual economic activity, from building things, from growth. And right now, the market is shifting from fear to growth. That's why gold and silver are topping and copper is breaking out. FCX is also less volatile than junior miners or exploration companies. You're not betting on one project. You're not hoping they hit a big deposit. FCX is an established business with proven reserves, steady production, and predictable cash flows. That makes it less risky than most mining stocks. Let me give you some more context on why this rotation is happening. For months, everyone was terrified about debt, about the dollar, about the system breaking, and that drove gold and silver to unsustainable levels. But that's actually happening, right? Trump's cutting deals. He's pushing for economic growth, for infrastructure spending, for manufacturing. So none of that requires gold. All of it requires copper. The narrative is changing from collapse to growth. and FCX is perfectly positioned for that narrative shift. They produce the metal that makes the economy run, the metal that's required for AI, for EVs, for defense, for infrastructure, all the things that are actually being built right now. There's also the political angle. Trump wants to bring manufacturing back to the US. He wants domestic supply chains. He wants energy independence. All of that requires copper, and companies like FCX with assets in North America benefit from that political tailwind. They're not exposed to unstable jurisdictions. They're not at the mercy of foreign governments. Now, let me address the inflation question one more time because it's important. Some people think higher commodity prices are bad because they create inflation. But remember, not all inflation is the same. If prices are going up because the economy is growing and people are building things, that's good inflation. That's real activity. That creates jobs. That raises incomes. The bad inflation is when prices go up, but the economy is stagnant. That's stagflation. But right now, we're not seeing that. We're seeing commodity prices rise because demand is strong, because things are getting built. That's a healthy sign, not a warning sign. And FCX benefits from that kind of inflation. Their revenues go up with copper prices. Their costs are relatively fixed, so profit margins expand. And unlike companies that have to buy commodities as inputs, FCX produces the commodity. They're on the right side of the inflation trade. Let me wrap this all up because I want to make sure the main points are clear. Gold and silver just put in a classic topping pattern. The parabolic phase is over. The smart money is rotating out and the money is moving into copper. Copper is breaking out to new all-time highs. It's showing relative strength, and the fundamental drivers suggest prices are going much higher. We're facing a structural supply deficit, 10 million tons by 2040. Demand is surging from AI, EVs, grid upgrades, renewable energy, and defense. And supply can't keep up because it takes 16 years to build a new mine. And we've been underinvesting for a decade. Freeport-McMoRan is the best way to play this. They're the largest copper producer. They have the lowest costs. They're already producing. They have growth projects. And they're cheap relative to history. When copper moves, FCX will move even more because of the leverage. This isn't a one-week trade. This is a position you build and hold as the copper bull market unfolds. And the beautiful thing is you're getting in before the crowd, before CNBC is talking about copper shortages every day, before the stock has already doubled. You're positioning now while it's still early. The opportunity is real. The fundamentals are there. And the people who understand what's happening are going to make serious money over the next few years. Don't wait until copper is significantly higher and FCX is already run. Position now while the setup is fresh. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, head over to stockscommunity.com. Try my Discord, the Stocks Community, for just $25 for 7 days. We break down setups like this in real time every single day. Plus, if you want the full transcript of this video and future videos, sign up at free.stockscommunity.com. The link is in the description below. So what do you think about this copper thesis? Do you think gold and silver are done? Do you think FCX is the right play? Let me know in the comments. I love hearing from you. But that caps off today's video. If you found this valuable, smash that like button. Subscribe to the channel. Share this with somebody who needs to hear it. Because the window is closing. The rotation is happening. And the people who position correctly in copper are going to make a lot of money in 2026.